Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
And welcome to The Bigger Picture. US companies are putting up with one of their best earnings seasons in 3 years on the back of robust economic growth, but still concerns about inflation, still high interest rates, as well as tariffs are all keeping the S&P 500 stuck in neutral for the past few weeks. And also, the US Services Purchasing Managers Index, that's what we'll be watching today on top of the stocks in Asia, which are primed to fall after Wall Street notched up its worst session of the year on lackluster US economic data. So from the latest on the US earnings front and economic data to the Asian stock market performance as well as the commodities market, let's break it all down with Daphne Tan, the Director of Business Development at CMC Markets Singapore. Good morning, Daphne. How are you doing today?
Good morning, Dan. I'm good, thank you. How about yourself?
Not too bad, Daphne. Thanks for joining us this morning. Now, lots to break down, so let's get started with the earnings on the US front. And like I've mentioned earlier, US companies, of course, are putting up one of their best earnings seasons. So what are you watching out in terms of earnings for this week?
Well, the biggest one we've got our eyes on would be the Nvidia earnings. That's happening on 26th of February, Wednesday after the close of trading. So that will be 27th February in Singapore. With Nvidia, they are the biggest of the Magnificent Seven, and they are currently expected to have a modest beat. So EPS is expected to be 84 cents per share, which would be up 63% from the previous year. And analysts project revenue to be between 37.5 billion and 38.2 billion. Now, if it comes in on the higher end, that'd be about 73% up from the same quarter the previous year.
Wow, that is definitely some huge numbers we're looking at, so we'll keep a close eye on that. Now, we got to turn our attention over to the PCE data as well, because just recently the US CPI that was released last week stoked concerns about higher rates for longer. But Fed Chair Jerome Powell was quick to stress how the Fed prefers the PCE data as their inflation gauge. So they also cautioned against reading too much into the latest CPI release. In terms of US data, the PCE index is something that we'll watch out closely. Are we likely to see a hotter than expected figure?
Well, it seems that the expectations for headline CPE, the January report, is expected to ease to 2.5% year-on-year compared to December's 2.6%. And with core PCE expected to come in lower as well at 2.6%. That's year-on-year from December's 2.8%. Now, while the inflation can be interpreted to be holding steady, it hasn't had any significant signs of lowering for the past 5 months. And the Federal Reserve has already signaled that they would like to see more signs of inflation easing before it considers further rate cuts. So while we do have rate cuts expected this year, it might not be till mid or later in the year.
Yeah, I think that might have to wait for a while until they see enough economic data to convince them that it justifies for another rate cut. So on to better news though. While Asia stocks are set to at least perform relatively muted today, we've got Alibaba's shares jumping almost 15% last Friday following their better than expected quarterly earnings, as well as, their commitment from management to make aggressive investments in AI. So closer to home, Daphne, Alibaba's stock price certainly has enjoyed some good bounce thanks to its recent optimism around its AI outlook. Tell us more about this latest data.
Well, I think it is a much-needed relief or revival that a lot of people have been wanting to see because with the Asian market, there are a lot of eyes on big Chinese tech. So it's gained more than 8% in Hong Kong and US after reporting strong earnings for Alibaba. Now, the sales rose 8% to the equivalent of 38.6 billion USD, and that beat expectations. And cloud services revenue also expanded the most on a quarterly basis in 2 years. So Alibaba, along with Tencent and Baidu, they are leading this rally. And contributing factors, which is interesting to look at, is also the turnaround in government relationship. I think they've come to see that Chinese tech is a growth engine for the dwindling Chinese economy. And as you've mentioned, the investments in AI is changing the perspective on Chinese big tech from risky to high potential, including the introduction of DeepSeek as well.
Yeah, and of course, let's not forget about their latest ChatGPT-like or chatbot, the Tong Yi Qian one. I think that's one to watch for Alibaba as well. Now then, let's broaden this conversation and talk about, Asian markets, because Morgan Stanley has recently shifted its stance to a more optimistic view on the Chinese stock market, and the bank highlighted that despite significant gains in A shares and Hong Kong stocks since late January, foreign investors have not fully engaged in this rally. That leaves substantial room for increased allocation. So what else is driving optimism in Chinese markets, and are there any other factors you're watching out in the Asian markets this week?
Well, I think it does take time for investor interest to become capital inflow, in which case they are also watching things like data, how the Chinese economy is doing, because if we look at the broader macroeconomic environment, the Chinese economy is not doing so well at the moment, and it seems to be struggling to come out of that. So, but we can look at the China PMI, which is coming out on 1st March, Saturday at 9:30 a.m. Singapore time. So while the Chinese tech equities may be fueling some optimism, the upcoming PMI data may actually provide a better indication, because generally for investor capital, they like to look at data as a support factor as well. So for January's PMI, it was 49.1, which fell short of the 50.1 consensus. So generally, a reading above 50 indicates expansion and below 50 indicates contraction. So we are somewhere in the middle with this. So I guess it's a wait and see for the China PMI at the moment.
Right. Make it or break it. We'll see how China performs in the next few weeks or months. Now let's turn our attention over to the commodities market, which has emerged as one of the winners so far this year, with gains handsomely exceeding those seen in US and global equity markets. So what can you tell us, Daphne, about the commodities space this week and for us to look out for?
Well, let's talk about gold. It is one of the things I like to talk about. And if we look at gold performance, it closed last week with its 8th weekly gain.
Wow.
And we have gold futures trading at about 29.52 this morning. It's risen about 12% since the start of the year. And spot gold is currently trading at record highs and close to the 3,000 mark, which in trading terminology, it's a psychological level. When it hits 3,000, it fuels some optimism in the market as well. So the resilience seems to be supported by geopolitical tensions and uncertainties related to Trump's tariffs. And if we look at the trend of that going forward, it appears that gold still has potential to appreciate in this climate.
Living up to his name as a safe haven asset. Thank you so much for joining us this morning, Daphne.
Thank you for having me, and have a great day ahead, Dan.
You too, Daphne. Now, we've been in conversation with Daphne Tan, the Director of Business Development at CMC Markets Singapore, talking all about the latest US earnings front, the Asian stock market performance, specifically China, as well as the commodities market. Keep it right here with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.